whatever that amount is, it needs and it should be invested somewhere. You should not be just sitting in a money market account and, crossing your fingers that you're going to, you need to be putting that money into something and having it grow. So at that point, it's like, what is going to give me the best return? Even if I'm losing some of the tax benefits, if I'm returning 15 or 16% a year, that's more comfortable and better for me than in the stock market. So.
Hey everyone, welcome to Investing for Generational Wealth. My name is Keshav Kulor and I'm joined by my co-host, John Lai.
Hi everyone.
We're from Clive Capital, where we help high earners just like you invest passively outside the stock market to achieve long-term wealth generation through superior risk-adjusted returns, long-term passive income, and tax benefits. Together with our investors, so far we've helped them invest passively into over 1,000 apartments under renovation, 500 single-family homes, rental homes under development, and we're expanding into industrial real estate, private debt, oil and gas, and a lot more. Before we begin, a quick disclaimer: we are not financial advisors. Well, maybe Scott, you are. I don't know.
No.
Okay, never mind. We are not financial advisors. All investments are subject to risks, including the possible loss of the money you invest, so perform your due diligence before making any financial decisions, and of course, consult your CPA, your attorney, your financial advisor, other professionals in your life before beginning investments. So John and I are joined by our dear friend, Scott Maurer. Scott, welcome to today's episode.
Yeah, thanks, Keshav. Thanks, John, for having me on. Looking forward to chatting with you guys today.
Yeah. So we have a very exciting topic today: using your retirement funds to passively invest into private equity opportunities. A lot of times when people think of their retirement funds, they think of 401k and the fact that it has to be locked up in the stock market. That is not the case, and today we're going to discuss what that process looks like. So Scott is someone we work with. A lot of our investors who use their retirement funds, they use their Roth IRAs or their 401ks, convert them into what are called self-directed IRAs. And we've helped a lot of our investors already so far, primarily from big tech companies like Amazon, Meta, Google, etc., use their retirement funds to invest into the apartment buildings, the homes, all those opportunities that we mentioned. So Scott, get us started. Tell us about your background, your career journey, and then what you're doing today.
Sure. Yeah. My background. So I've been with a company. Our company is called Advanta IRA, and we're, like I said, in the self-directed IRA space, and we'll obviously dig a lot more into that as we go along tonight. But I started with the company 18 years ago. I actually, my educational background is I have a law degree. I don't practice law for Advanta clients and for the people using their IRAs to invest. It's not something I'm permitted to do, but that's kind of my educational background. And I got started so many years ago in this business. Our owner is also an attorney and a certified financial planner, and had this company. That's how he and I connected. And just started working with him at the time. We were about 4 or 5 total employees. We're up over 50 now. In the time that I've been there, and seen some great growth over the years, especially in the space that you guys are in, into real estate syndications and other types of passive funds and whatnot. So it's kind of been my journey. I knew very little about this when I started 18 years ago. Learned the ropes, kind of followed our owner around, just learning and hearing him talk about it. Met with countless investors over the years who've exposed me to a lot of different investment options and a lot of different types of things that people do. I think when I first started, most of the clients we dealt with were focused on going out and finding their own rental properties. They're actually going out and buying a 2-1 or a 3-2 or a condo inside the retirement account, and really transitioned a lot over the last probably 5 to 10 years in dealing a lot more the private funds and people who are really looking for that true passive income. People investing in a rental property, it's still considered passive by the IRS to receive rents from a condo or a rental house, but a lot of people know that's a lot more work involved. So again, we've just seen so many more people as they become aware of self-directed IRAs really look for this type of strategy. That's really what's grown our business in the last, like I said, 5 to 10 years, and it's something that we focus on.
Yeah, it's definitely huge. I know my parents have invested into some of our deals using Advanta IRA. Other family members, I just received some money yesterday from an investor, that we worked with Advanta IRA. So it's definitely a powerful concept. So Scott, I guess let's start with why more people aren't familiar with self-directed IRAs and the fact that your retirement funds don't have to be locked up in just the stock market.
Yeah, I mean, the biggest reason is that most people who have an IRA or an old 401k, I mean, a lot of IRAs start from old 401ks as well, where you're working for a company, you're working for an entity that, you're putting away some of your hard-earned money each month or each year into the plan. Your company is doing maybe a matching contribution, but those plans are almost universally held with companies like Fidelity, like Vanguard, like Charles Schwab, where your investment options are going to be limited to only the things that they sell. It's not an IRS rule that you have to invest in mutual funds or stocks. Obviously, that's why we're talking tonight. But that's what most people associate their retirement account with is that industry because that's where their funds are located. They're not going to be told by their representatives that there are other options out there that you can invest in real estate, you can invest in oil and gas, you can invest in private funds. Those companies choose not to hold those assets. It's not that they can't. They make a decision not to hold those particular investments inside of a retirement account, but that's why we exist. We kind of fill that void in the market. So it's the fact that most people aren't necessarily looking for it, or if they are and they're asking those particular providers, they're not either they might say, hey, you can't do that because you can't do it on their platform, or they just don't want to lose the business. So it's the fact that most people, again, it's not an option when you log into your Fidelity account and say, hey, do you want to invest in some private passive real estate funds? It's so that's why most people don't know that it's possible. If they have to listen to a recording like this, or talk to one of you guys, or meet me out at a networking event to find out. A lot of times, this is the case, and you do have other options.
How long have self-directed IRAs been around?
So the IRAs were created in 1975. Since that time, everyone has had the ability to invest in alternative assets. In fact, when IRAs were created back in 1975, there were only a few restrictions placed on what you can or can't do with the accounts. In fact, the IRS rules say the only two investments you cannot make inside of your retirement account are you cannot buy life insurance and you cannot buy things that are deemed to be a collectible, like artwork, antiques, vintage wines, things like that. Those are the prohibited investments, but nowhere in the code does it say you can invest in real estate, you can invest in stocks or mutual funds. They simply say you cannot invest in those types of assets. And there's also some restrictions on what they call the self-dealing rules. If you're buying, say, a rental property inside your IRA, it's not something you can live in, you can vacation in. There's some restrictions about certain people who can or can't use a particular asset. But outside of that, again, it's self-directed. The ability to self-direct your account has been around since 1975. And I think it's important to note that it's one of the common questions we get, even when people are, say, filling out paperwork with us to open up an account, is, I have a traditional IRA, but I need a self-directed account, or I have a Roth IRA, I need a self-directed account. How do I do that? Self-directed is a marketing term. It is a more of a name that we use to describe the ability for people to invest in assets that they understand that they can control, or that they want to put in their portfolio. So the accounts we have at Advanta are still traditional IRAs. They are Roth IRAs, they are SEP IRAs, they are old 401ks that get rolled over, and they're subject to the exact same tax treatment for contributing to the account, for taking distributions from the account. The difference that self-direction means is that you have, as the account holder, the ability to direct those particular investments.
So we know that, the big thing with self-directed, like you said, is you can invest into basically whatever you want with some caveats. And I mean, like if, folks tuning in, if you know what we do, we help investors invest into these syndications, private equity opportunities, typically targeting a 15 to 30% return, whereas the stock market averages a 10% return. Like even considering the bull run that we've had, I was just crunching the numbers a few days ago. Over the last 10 years, the stock market has still averaged 10.7% return, I think.
Mhm.
Assuming you just bought and held, not assuming you're a day trader or anything. So besides the fact that we know private equity opportunities, typically offer better returns without too much more risk, and in some cases even less risk, right? Like apartments, real estate, much more stable asset class than the stock market. Besides the returns, what are some of the other advantages that self-directed IRAs have over traditional retirement accounts? Is there a different fee structure? Why else should someone switch over?
I mean, the primary motivate there's really, I would say, over the years I've worked here and the clients I've met, there's been really three motivating factors why people choose to self-direct. I mean, one can be a tax decision. If they're presented with, say, an investment like yours, an opportunity with a high rate of return, they're like, hey, that sounds good, but unfortunately, right now I'm a high earner. So if I invest personal money with you, I'm going to be paying a much higher rate of tax. I'd rather do this inside my tax deferred or tax-free IRA account and not worry about the taxes now. I can, we'll just kick that can down the road. I'll worry about it another 15 or 20 years when I retire. So for some people, it is a tax decision. For some, as you mentioned, I think it's the fear of the stock market. As you mentioned, the average quote, so to speak, is what, 10% or so. I remember sitting through a presentation once, though, someone said the number of years where the stock market has actually returned like around 10 or 12% is very few. It's actually, there's years when it's like it returns like 15 to 20%, and there's years when it loses, but that's the average. So for a lot of people, they look at something like that and figure, I have to time, I'm trying to time the market, and it makes them uneasy. So if they can get a consistent return somewhere else, it's really kind of a diversification play for them. And I think for the other motivating factor for a lot of people is it's simply there. It's somewhat of a FOMO, the fear of missing out, where here's an investment opportunity. I see the rates of return. I see the history. I see the track record of the people that I'm investing with. So I know that I'm going to get that rate of return. I don't want to miss out on this investment opportunity. So, I want to make this investment. I need 50,000, I need 100,000, I need 200,000 to make this investment. Where is that money sitting for me? And for a lot of people, it is in an IRA. It's in an old 401k account. They may have a savings account with that amount of cash in it, but they're reluctant to maybe take some of that cash out of a savings account and put it into something that's illiquid. Where if they do have an emergency for a job loss or for a medical situation, they want to have access to that savings account. But their IRAs, their 401ks, that's money that's kind of already pushed aside. They're not touching that till they hit retirement age anyway. So that's really, again, one of the motivating factors is this is where my cash is at. This is the investment opportunity. It sounds good. I don't want to miss out on it. What are the different ways I can take advantage of it?
Yeah, I think that's great. Like I know over the last few years, there's been a bunch of layoffs. There has been uncertainty. So a lot of people like to keep cash on hand. You can't touch your retirement account anyway, so why have it only doing 10% of the stock market when you could have it doing higher double digits in some of these syndications?
Yeah, absolutely. And again, I think it's a matter of people understand. I think a lot more people, the general public, probably understand real estate investments just as a general, than they maybe understand picking a mutual fund or a stock or which one do I need to invest in. So again, it makes them maybe feel more comfortable. Like, hey, at least I have some of my money in a consistent return over here with people that I know or people that I trust. Not worried about, hey, the stock market tanks a little bit, or there's an event happens halfway around the world in another country. Now all of a sudden, my 401k is being affected by something out of my control. So I think that's, again, for some people, it's that let's put some money aside into something a little bit different that I know that I can control.
What types of retirement accounts are eligible? Or if it's phrased better the other way around, are there any retirement account types that are not eligible to be
Yeah.
converted to a self-directed IRA?
The only restriction that we come across when it comes to retirement accounts, so we see any type of IRA can be self-directed. Again, traditionals, Roth IRAs, SEPs, and simples if you're self-employed. Those can automatically be self-directed. That's just a matter of, again, doing the paperwork. The only restriction we a lot of times will see are with employer-sponsored plans like 401ks, 403bs, 457 plans, when somebody is currently employed. So if you still are working for the company that is sponsoring that employer's plan, they may prohibit you or limit you from being able to move that money while you were still employed. But as you mentioned, Keshav, if you're laid off, if you retire, you just switch jobs, and now it becomes a former employer's plan, then at that point you do have the ability to move into an IRA. So really, the only again restriction is on those current employers' plans. There it's kind of all over the map a little bit. There's most of them, if you're still employed, do not allow you to move it, but there are always different plans here and there that are structured differently. I actually spoke with a gentleman earlier today where I think he has an account around 190K through his current employer. He's able to access about 50K of it. So he's going to, he wants to self-direct at least what he can access. So if it's a current employer's plan, I would just encourage someone to, check with your employer and see what flexibility you might have.
Yeah, it's unfortunate. Like a handful of times I've talked to investors and I'll say, "Hey, did you know you could use your old employer's funds?" And they're like, "Ah, I just rolled it over into my next employer."
Right.
Yeah. So don't, if you're interested in investing in these opportunities and using retirement funds, when you switch jobs, when you get laid off, do not roll your, you know, funds over into your next opportunity, into your next job, I mean. Put it into a self-directed IRA so that you can invest.
Or at a minimum, I would say move it to a brokerage IRA where you're going to have the same investment options that you have in your current 401k, but you'll have the flexibility to touch that money later. And I think that's where, yeah, people change jobs like, oh, let's just move it to the new employer's plan. That'll make it easier to have everything over there. Well, you don't realize you just locked up your money inside your current employer's plan. So even if the initial step, let's just put it into an IRA account still in the stock and mutual fund market. Once it's in an IRA, you will be able to, at that point later, pull out whatever portion of it that you wish.
What investments are best to invest out of a self-directed IRA? Like, obviously, there are tax efficient investments, but then there are ones that throw off a lot of capital gains. So, could you talk a little bit to that?
Yeah, I mean, I can tell you, I mean, probably 70% of the assets that we have, I say we hold on behalf of our clients' accounts at Advanta IRA are real estate in nature. Um, and I know I've talked to CPAs over the years that will say, hey, well, you shouldn't hold real estate in an IRA because some real estate investments have depreciation and great tax write-offs. And within an IRA account, you lose a lot of that because you're not paying tax on the gain. So, I think for investments that are spitting off straight interest, that usually makes just a flat return. When you're not worried about the deductions and depreciation, I think that makes a lot of sense. But um, a lot of times it comes back to the clients we're talking to, and maybe some of your investors as well. This is where my money's at to make the investment that I want to use. So that tax implication is not always the deciding factor. You have money in an IRA, you have money in an old 401k, whatever that amount is, it needs and it should be invested somewhere. You should not be just sitting in a money market account and, crossing your fingers that you're going to, you need to be putting that money into something and having it grow. So at that point, it's like, what is going to give me the best return? Even if I'm losing some of the tax benefits, if I'm returning 15 or 16% a year, that's more comfortable and better for me than in the stock market. So again, probably 70% of the assets are real estate in nature. That's anything from single family rental properties, people flipping houses, people obviously investing in private funds and real estate syndications, people lending money from their IRA and just getting just charging someone an interest rate. So a lot of that, a lot of other private placements. You guys mentioned obviously oil and gas, other types of private hedge funds, private startup companies, things of that. People invest in gold and silver with their IRA accounts, more of a hedge against inflation, probably not looking for a return from that. But there's a lot of different things you can do. So it's really the motivating factor, and I think is going to be what the client is looking to get from it. Is to determine what's going to be the best investment they see. And again, for that client, it's going to probably be something they're comfortable with.
A question came in about fees for self-directed versus traditional funds. Could you talk about the different types of self-directed IRAs and then the related fees?
Sure. So again, the different types of self-directed IRAs are going to be either traditional IRAs, Roth IRAs, SEP IRAs. We could do solo 401ks for self-employed individuals. Our fees are a little bit different. I mean, a lot of folks who have retirement accounts don't see some of the hidden fees. They see an account statement once a year that says like, annual account fee, $100 or $50, and they don't see all the other little fees that mutual funds charge. They don't because they don't get placed on their statement on a line item as a fee. Or some people have money invested with an advisor who charges them a management fee each year, and their IRA is part of that overall portfolio. Our fees, we are not providing advice. We don't solicit investments for our clients. We don't try to put our clients into anything. So we just charge flat record keeping and custodial fees for, say, if you're investing $100,000 into a private fund or even $50,000 into a private fund. We charge a $50 account opening fee. We charge a $95 processing fee to do the investment paperwork, to make sure all the documents get properly titled and make sure the client's approved of it. And on an annual basis, it's a flat $295 a year to hold that asset. So if it's 50,000, 100,000, 500,000, it's the same $295 a year fee. It's the same work involved for us. And so again, we're not charging commissions. We're not charging a percentage management fee or anything like that. It's just a flat admin fee, which again is a little bit different. And some people see the $295 and think that's a lot because I don't see that on my mutual fund account. You're not necessarily seeing all the different fees you're paying in the mutual funds you're invested in.
That 295, is it a flat fee or is it based on how many investments you make? Like, as your account grows and you make multiple investments, are there different options?
Yeah, great question. So it is as a per asset fee of 295. As you grow your account and look to acquire more assets, you kind of have a few different options to keep your fees down with us. One is we do have a separate fee option where we bill the fee based on the total value of the account. It's still kind of like a flat fee that is just tiered as your account grows. Or we've had other clients utilize kind of an investment strategy that gives them more control and it also reduces their fees with us. And in our industry, they call it a checkbook LLC or a checkbook control LLC, where instead of having, in this case, say, Advanta as your record keeper, invest in 3 or 4 different assets. And each time you're coming to us to distribute the funds, hold the investments, receive the income, you could set up your own LLC, kind of like a private investing entity that is 100% owned by your IRA account. So rather than having Advanta send 3 or 4 different investments out at different times, you can have us take all of your funds, invest in the LLC, and then you, as the account owner and manager of the LLC, set up a bank account. You make all the investments through that LLC structure. And from our perspective, it is just a single asset of your account. So even if your LLC is investing in 3 or 4, 10 different investments, on our books, it is just one holding. So we're only charging one $295 a year fee. So for someone whose account is growing and you're looking to acquire more assets, that's something you can bring into the picture later on when it makes sense. You could set it up that way initially. It's really up to you, but there's a couple of different ways you can limit the fees.
So that checkbook LLC, conversion, that can happen at any time, like as you start growing assets.
Yes, yeah, we've had people make a single investment with their IRA just actually sometimes just to see kind of how we operate and see really how paperwork needs to be done. So they kind of modeled what we do for themselves. And at that point, they switch over to the LLC mode. We assign all of the assets that they have and send any cash then to the LLC's account for them to manage going forward. So yeah, you certainly have the option to switch back and forth whenever you want. There might just be some paperwork involved when you do that.
Got it. Okay.
We have some investors that are on the residential side and some on the commercial side. And you spoke about prohibited transactions before. Could you talk a little bit about that?
Yeah, so again, there's prohibited investments, and then there's what the IRS terms to be disqualified persons. And so again, the
Right.
prohibited investments, you can't buy life insurance and collectibles. That's just flat prohibition. The other area of the rules that pops in, especially with people, I think more on the residential, when you're buying, say, a single family home, a property in the beach, property in the mountains that you want to use for rental, there are certain disqualified persons who cannot transact with the IRA or receive any benefit from the investments held in the IRA. So if your IRA buys a property, no disqualified person can actually live in or use that property. The disqualified persons for an IRA include the IRA account owner, their spouse, their parents and grandparents, and their kids and grandkids are all considered the disqualified persons who cannot, again, transact or benefit from the investment in the IRA. So again, if your IRA buys a rental property, you can't go use it when it's not being rented. You can't buy a vacation home. You can't buy your primary residence through your IRA. You can't lend money to any of those individuals. So you can't lend money to a son or a daughter or buy a house for them to live in and to rent from you. Those are all strict prohibitions as well. When it comes to self-dealing, there is no carve out or caveat for making investments on a fair market basis. Like, oh, I'm renting the property to my son at the same I would rent to a third party. It's still considered prohibited. But outside of those individuals, you think about brothers and sisters, aunts and uncles, other friends, individuals, those individuals are not considered disqualified. So your IRA can transact with brothers and sisters and other, get close friends and colleagues. It's just directly up and down your lineal tree are the prohibited transactions.
And does that include, for example, LLCs that someone sets up for themselves and then they have a self-directed IRA? That includes that as well, because that's the same individual.
So yeah, with the checkbook strategy, right? If you use your IRA to set up that type of entity, that entity is subject to those same rules. I don't know if that was the answer to your question, or if you personally own an LLC, you can't have your IRA lend money to that entity. Yeah. So the disqualified persons include the individuals I named, as well as any entities as well that are owned by those individuals.
And so
Got
does
it. Okay,
that mean that you can use your self-directed IRA to buy a rental property and rent it out to someone not in your lineal tree? Like, can you still do that or no?
Absolutely. Yes. Yeah. In fact, a lot of, again, so again, the clients we hold that have clients we have that hold real estate, again, a lot of them hold private syndication investments like you all do, but then there's also people who go out and buy, a house comes available in their neighborhood or in their city. They're like, hey, I'd like to, that looks like a great income producing property. They use their IRA to purchase the asset. They rent it to a third party, and that rental income each month flows right back into their IRA accounts because all the profits have to go back to the IRA. In those instances, the IRA also does have to pay any expense related to the asset. So the property taxes, the insurance, any maintenance has to be paid from IRA cash as well. So you have to make sure that you have enough, obviously, in your IRA to acquire the property, kind of carrying costs if needed before the rents start coming back in. But certainly we have a lot of people who have made that their strategy, and they don't mind maybe being a little bit more involved in choosing tenants, choosing the property, deciding who needs to do the maintenance, et cetera. Obviously, there's the other flip side of the coin. A lot of people are like, I don't want to bother with that. I'd rather just invest in a fund and have just receive a rent, receive a check each month or each quarter. So it's kind of, again, depending on the personality of the investor, you have that flexibility.
We have two questions that came in about the type of investments. So first of all, can you own real estate out of the country, or is this for US only? I think that's the easy answer.
Yeah, good question. You can own real estate wherever. The issue is what you're using it for. So if you're buying a property out of the country and using it for rental income, absolutely fine. You just can't be something you want to use personally. The only caution I would mention when you're buying property out of the country, what you need to do as an investor is to find out the laws of that country and how they allow real estate to be held. We had some clients years ago want to buy a property in Costa Rica. Costa Rica law requires that all real estate be held by a citizen of Costa Rica or a Costa Rican entity. So the clients had to set up a Costa Rican corporation to then make that purchase. So, but then no geographic restriction, just you'd want to check with the laws of that country.
And then the second question relates to what type of investment options are available within the IRA. So I guess the question really is, does Advanta or Advanta affiliates have any private equity options available
So,
to
again, with the accounts that we hold, we do not promote any particular investments. It's not and I should say, promote specific investments. Obviously, I'm talking with you all today and your investors. We have a lot of clients who invest in private equity. We're out there, encouraging people to say, hey, this is something you should look at. But We don't have investments for people to choose from. If you were to move cash to an account with us, you would then tell us what it is that you wanted to invest in. It's not going to be you move the funds to us and you say, okay, now what do you have for me to choose from? That's not
Right.
something we're able to do.
Are
Got
you
it.
still
Okay.
able to invest, like through a self-directed IRA? Are you still able to invest back into public markets if someone wanted to?
Oh, absolutely. I mean, most of our clients, I'm not sure what percentage exactly, but most of them have IRAs with us that are holding the various assets we've talked about tonight, and they still have an IRA with a brokerage firm, a Fidelity, a Schwab, or whomever, and they transfer money back and forth between those accounts whenever they'd like for whatever purpose. So if they move, say, $100,000 to us to invest in a private equity deal, they're getting 10% on their money, right? So that means they're getting $10,000 of cash back to their IRA every year. If they don't have another alternative asset to place that in, they very well would just simply transfer that cash back to an IRA with a brokerage firm to have that money earning interest. Because again, we're not going to be able to place that into any particular investment for them. They're going to have to tell us to do something alternative, or maybe go back to a brokerage house to do those assets. But the IRS allows you to freely transfer between IRA accounts as often and whenever you'd like, just so long as the money goes directly from one custodian to the other. So again, I think that's very important thing I think for people to understand is that self-direction is not an all or nothing strategy. If you're like, hey, this sounds really good, but I don't want to move everything over and just go, head in 100% into real estate right now, then don't move over what you feel comfortable doing, make the investment and see how it goes. And if it just turns out that, I'd like to do more of this, you can transfer more money over to a later date. Or conversely, I did my deal, I made my money, not interested in doing anything else, take the money right back and go back to a brokerage account.
And about for buying foreign assets, that applies to anything even outside of real estate, right? As long as it's not collectibles or life insurance, you can buy anything. Foreign.
Correct. Yeah, we have a number of clients, a handful of clients who have investments in Swiss bank accounts. So they have financial advisors in Europe, and they would like their money in European equities instead of U.S. equities. So they're still investing, almost, or ironically, still in stocks and mutual funds, just in overseas markets. And then again, they have to use our services to be able to take advantage of that. So yeah, it really doesn't matter. Again, as long as it's not a collectible and as long as it's not life insurance.
How easy is it for foreign investors to invest? Like, how do retirement funds in other countries work? Is that something you've interacted with, and then using those funds to invest into U.S. opportunities?
So to take that question two ways. So the first way you're asking, we can only deal with U.S. based retirement accounts. We have had a couple of people over the years who maybe were living in the U.S. now and they had a UK retirement account, or they have a Canadian retirement account. Unfortunately, we can only hold U.S. based retirement funds like IRAs or 401ks. So if they have those types of assets, there may be providers in those countries that do something similar to what we do. I don't know what the laws are there. So that's one answer. The other answer I thought maybe you're going with this question too. There are foreign citizens who have worked for U.S. companies who have IRAs. They built up a 401k with that employer and they had to roll it to an IRA under US law. They don't even live in the US, but we can still work with them to make investments because in that case, we are still holding their IRA account. So I'm probably guessing we probably have 20 to 25 clients who don't even live in the US. Maybe probably more than that actually, but there's no restriction from us on where the client is. It's whether or not their account is subject to, US retirement laws.
Interesting. Do
We had a question
other
that came
countries
in. Oh, go ahead. Sorry. Finish up
I
your
was gonna
thought.
say, do you know of other countries that have a similar concept where you can use retirement funds to invest outside the stock market, or no?
I don't. Honestly, I don't know. I would guess that maybe that some of them do. I just honestly I don't know the rules. Like I said, people have come to us and said I have a it's called the RCMP. Not sure. Maybe I can't remember the Canadian, whatever the Canadian retirement. I might have just did the Canadian Mounted Police. Actually, that's probably the wrong acronym. But whatever the Canadian-based system is, I've had people ask me about them. So unfortunately, it's not something we can handle. I didn't really look into any further. So, but I'm sure that some of them probably do have that option.
I was going to say a question came in. I'm just going to read it directly. In terms of having a property manager, can someone in your direct lineage manage a rental and get paid as a manager, or is that prohibited as well?
So that would be prohibited. So in that instance, if you've purchased a rental property in your IRA and you've hired a property manager, it cannot be somebody in your direct lineage who's going to be receiving the income, paying bills, and then keeping a portion of it. That would be prohibited because now somebody in your direct lineage is getting a benefit. They're getting paid from the property. That being said, our clients who own real estate in their IRA, they manage, so to speak, as a quote unquote manage the property, that they're selecting their tenants, they're deciding what work needs to be done, but they're not getting paid for it. Um, and they're hiring outside people to do it, and all the funds are flowing directly in and out of the IRA. So that is an option. But yeah, as far as that question specifically, if you're hiring a property manager and paying them, it's got to be someone who's not disqualified.
Got it. Okay. And I'm also thinking like a short-term rental, whether you buy a short-term rental, put it onto wherever it might be, Airbnb or whatever it might be, and you're hiring like housekeepers to clean up the place, but the Airbnb manages the actual individuals that are renting. Would that be
Right.
okay? That's fine, or is that
Oh,
disqualified?
absolutely. Yeah,
Yeah.
no, absolutely. Yeah, because that's Airbnb, a separate company, is handling that. Maybe you as the IRA owner are involved in helping get it set up so that the rents flow back to your IRA account, but you're not getting paid for that. There'd be no issue whatsoever.
Got it. Okay.
And then just so my memory is correct, you said that you could invest into like assets anywhere in the world using a US. Uh,
Yes.
okay.
Mhm.
Do you know if like other countries would have a problem with like taxes, and like would they tax you on your gains in that? Like if I was to invest in Switzerland, I know I understand we wouldn't get US taxes, or we'd be kicking the can down the road.
Mhm.
Do the Swiss respect that as well on my investment gains?
That's actually a great question because it has come up with those particular investments that I mentioned in those accounts. So it is something as an account owner, you'd want to check the laws of that country. I think in Switzerland, I believe there is a tax that applies to some of the gains, but there is some type of treaty or agreement between the US and the Swiss when the tax is charged, but then you get a very, very large portion of that back. But you have to file the right forms through the Swiss government to get a refund of a lot of those taxes paid. I don't know that it's 100%, but it is a significant amount you get back from the tax. That's a great question, Kesha, because you do have to. That's something that's again, the U.S. law. The U.S. is not going to tax you on that income, but the IRA could be subject to that tax based on the laws of that other country.
Who's usually best to talk to when you're dealing in like international investments? Is it like are cross-border accountants a thing, like someone, or would you just have to find like yeah, who would you talk to if you wanted to understand how the Swiss would tax your investments?
Yeah, I think if you could find a cross-border account, that would certainly be the first person I would go to. The alternate, I mean, maybe the people that you're investing in, especially again, at least in the instance I'm talking about, our clients that are investing there are investing with other financial advisors who have that background and have that knowledge of what can happen with foreign individuals investing. So it would be more so as well getting a full disclosure from those individuals. What are the drawbacks? What am I looking at tax wise? Are there any other hiccups? Things are going to pop up and surprise me a couple years down the road. Or seeking out the tax advice of a tax professional in that particular country would make sense to me too.
I
Got it.
think you had some case studies that you could show us. It might be useful to run through one or two case studies just to see what that looks like.
Sure.
Yeah.
Yeah, I'll show you kind of what it looks like. Let me pull it up here on my screen. Um, if you guys can see that there. So it's really just a quick just case study of what the process looks like if you're looking at investing in this syndication with your IRA or 401k, what the process looks like, and a little bit about what we do as the administrator. So in this situation, we have an individual. John is the one who has the money inside of his Roth IRA account, meets Jane, comes across an investment opportunity. Jane provides John with the subscription documents, the prospectus again. From an investment stake, investment perspective, Advanta is not going to review the prospectus. We're not going to review the pro formas and all of the numbers and say, hey, this looks like a good investment, John. That's up for him to do. So he is going to review those documents and be comfortable with obviously moving forward on it. So John and Jane talk. Jane maybe says, hey, you can use your IRA to invest with us. So John's first step in deciding to go this route would be to open up an account with Advanta. It's kind of like opening up a basic bank account. You're giving us his personal information. He's naming his beneficiaries. And then he's giving us the information on the Vanguard account and that he wants to transfer $100,000 from that account over into the Advanta account. Again, we will submit the request to Vanguard to make sure that that money is transferred tax-free. There's no implications to John. There's actually nothing he even needs to report on his tax return when doing this transfer from a Roth IRA to a Roth IRA. We handle all the reporting on our end, and Vanguard does as well. And there's nothing that John needs to reflect on his individual tax return. So we'll set up his account. We will request a transfer from Vanguard and obviously notify John when that money does arrive. Usually that process takes, the account's set up in a day. Getting money transferred from another custodian takes anywhere from a few days to a week or two. Really just depends on who that other custodian is and how quickly they act. Once the account's set up, the next step really is getting the investment paperwork filled out. So if you're investing into a private fund, there are most likely going to be some type of subscription documents that need to be completed where you list the investor's name and the subscriber's name and the tax ID number and the address, etc. When you're investing your IRA account, it's important that those documents all get completed in the name of your IRA account specifically. So you can see on here that the subscriber's name would not be John Smith. It would be Advanta IRA for benefit of John Smith's Roth IRA and his account number. And the tax ID number that is used for the investment is Advanta's trust tax ID number, not John's social, because we don't want any tax reporting, any of the gains that he's going to receive from this investment for the year. That should all be reported back to his IRA account and to our trust tax ID, not his social. So again, part of our role in the process is making sure these documents get completed properly. Then we also send them to John for his final review and approval. So he's got to go through an initial each page. Yes, I accepting of this particular investment. I want to move forward with it. At that point, we will sign the subscription documents on behalf of the IRA, and we wire the money out of his account, basically to complete that purchase. So from that standpoint, John has opened up his account. He moved $100,000 in cash. His account statement with us initially was showing $100,000 in cash. We make the investment. Now on his account statement, John would show a $100,000 investment in this particular private deal with Jane. Going forward, any of the dividends, any of the profit splits, Jane would send back to John's IRA account. She can send it to us via wire, via check, via ACH. And again, those account gains are all accruing back to his Roth account. In this case, with a Roth account, that's tax-free money. So Roth accounts the gains are all tax-free. So John's account is just growing tax-free. Again, that is not income to John that he has to pay tax on. This is income to his Roth account, which is a separate legal entity from John as an individual. So the money is coming back into his Roth IRA. Whenever he exits the investment, all of the proceeds from that as well will come right back into his account. Again, no tax consequence to John whatsoever. Again, as that money is coming back in, he could direct us to transfer it back to Vanguard if he wishes. He could take that money and bring some more money from Vanguard and make an additional investment. He's going to have that flexibility. So really the exit strategy for John will be whatever he determines it to be. I want to continue, maybe this investment does really well with Jane. He says, hey, Jane, when's your next deal? When's the next investment I can put more money into? And let's just roll the funds over again. Or says, I wanted to try this out. It was great, but I'm going to move all my money back to Vanguard. So again, you have that flexibility with these particular accounts. That's really kind of just a quick case study. If you're buying single family rental properties, instead of going through subscription documents, we're going to be involved in the contract and all the closing documents and making sure those reflect your IRA account, and the deed shows your IRA account as the owner. If you're investing in private loans, same thing. We're looking at the lending documents. So That's our role as the administrator and custodian. Again, we are not trying to sell you an investment. We are not trying to approve of your investment. We're simply making sure that everything gets titled properly and make sure you approve it so that there's no tax consequences to you.
Would this be the same process if you had the checkbook writing self-directed IRA as well?
Great question, John. And no, yes. Well, I should say yes and no. So
Right.
the part of the process, yes, he would be the same opening up of the account, transferring the funds from Vanguard. All of that is exactly the same. But when we get to this stage of the process, the investment, we would want to see if you're investing in the checkbook strategy, we'd want to see the operating agreement for the LLC. So you're setting up an LLC, you should have an operating agreement that lists who the manager is and lists who the member is. And we would want to see that same wording here, the Advanta IRA, FBO John Smith IRA, as the member in the operating agreement. So in that perspective, we're looking at the operating agreement, having John review and approve that document, and then ultimately wiring money to the bank account for the LLC. So that would complete the investment process on the IRA side with us. And John's IRA would now show a holding in whatever private LLC he has. If he then wanted to take that cash and invest with Jane or whomever, when he fills out the subscription documents or he buys a single family rental property, all of those documents would be then titled in the name of his LLC. And he would issue the money out of the LLC bank account. But if you're using a checkbook strategy, a lot of this is similar. It's just what investment paperwork we're going to need to have completed.
Got it. Perfect. Thanks.
Once you've invested, from the investor's perspective, what does the ongoing maintenance or work look like for, I don't know, like financial statements or like tax forms, anything like that they have to prepare?
Great. So, not necessarily a lot. I mean, there's not, again, the tax statements, we will, if they ever take a distribution from the account, we issue a 1099, just like any other IRA custodian. Every year we have to provide an annual form 5498 to the IRS that states the current value of the account. So the one thing we do ask clients on an ongoing basis is to provide us with an updated value of the asset in their account. So in that last case study, if John's invested 100,000 with Jane here in 2024, come the end of 2025, what's that $100,000 investment worth? Is it still the same capital value? That's fine. You can provide us with a letter, or maybe Jane sends us a letter and says, hey, the investment is still worth 100,000. And we use that to update our records and send the report to the IRS. But that's really the only ongoing thing you have to do from an IRS perspective, is really just provide us with that valuation. Depending on the asset, if you're buying a single family home, obviously there's going to be a lot more things that you're doing on a probably week to week basis, and with your tenants and maintenance items. If you're using the checkbook control LLC and using that strategy, you need to make sure you're keeping good records and keeping good books for your LLC, so that you can document the income coming into the account, the expenses going out.
Got it. Any other, I guess, thoughts, best practices, or gotchas that you can think of investors typically run across?
Yeah, I mean, again, I think it's important just to remember the due diligence aspect. I mean, again, and not that it happens often, but it has happened a few times, obviously, where people get confused and think that, oh, because Advanta is allowing this investment, it must mean it's a good idea for me. And like that's certainly, again, we're making sure things are titled properly. You're making sure that that investment is the right deal for you. So I make sure, for clients, just evaluate what you're doing from that perspective and be comfortable moving forward. If you do get into those areas where we talked about the disqualified persons, have the conversation with us to make sure that you're not doing something that runs afoul of the rules. If you forget it, it's better to I always say, call us and say, can I do this? Rather than like, I just did this. Is that okay? Definitely better to ask for permission rather than forgiveness in that regard. So, yeah, I think that's important to have that understanding of the rules. I don't think, I've run into some people over the years who feel like they have to know everything about self-directed IRAs before they move forward. And I don't think that that's necessarily something you have to do. It depends on what you're investing in. For people who are gold and silver bugs who just want to invest in precious metals, they don't need to know about the laws involving real estate investing with your IRA account, and vice versa. So I think that's not to get too overwhelmed, but I think that could be a gotcha for some people. They get that paralysis by analysis, where they really think way too, think hard about it. Think this is complicated. I haven't heard of this before, therefore it must not be for me. I mean, I must not be smart enough or sophisticated enough or able to do this. And it's actually a pretty simple and easy process. It's not, we don't have a certain kind of category of investors that we work with. We have people who definitely have built up large 401ks through private employers over the years. We have people who worked at the local school board and built up their nice 403b as an educator, or even as a custodian at those schools. So again, it just really depends on what you're looking to do and be comfortable in doing it.
And another question came in. Do you have to have an opportunity or an asset you want to invest in before creating an account with Advanta?
You don't have to, but I'll be quite honest. If you were to open up an account with us and just move a bunch of cash to us, it's going to sit in a cash position. We're not a broker dealer, so we can't just put the money into a mutual fund or stock while you wait to find an investment. It makes sense to kind of have that opportunity in mind. And again, I guess that depends. If you're investing into a private fund, you're going to identify the fund. You're going to have a few weeks to get that investment made, and you complete the process. If you're somebody who's looking to buy a single family rental property, it probably would be a good idea to open up an account and at least have a few $1,000s in the account for an earnest money deposit. So when you identify a property, we can get that property under contract and issue a deposit. So it depends on the type of asset. But you can always open up an account, put a few $100, put $1,000 in it just to have it ready to go for when you do come across an opportunity. But again, depending on your investment, you're probably going to have some time to get that done. Again, the most of the time it takes somewhere between 8 to 10 days and 2, maybe 3 weeks to get an account open and get it funded. The biggest hiccup is with the old 401ks because a lot of those companies will always insist on mailing a check to you or to us for deposit. And that's just going to take a little bit longer. But IRA to IRA is usually, like I said, within a week or so.
Another question came in. Does that mean that there are no in-kind transfers to Advanta?
So we take in-kind transfers, but in-kind would be, say, someone's transferring from another self-directed custodian. They have a piece of real estate or they have a private holding, like a private fund with another company. We can certainly take those in. We just don't take in mutual funds or stocks typically because we can't sell them. I mean, we have the ability to open up a brokerage account inside your IRA with us as well. But then we would be transferring assets into that brokerage, that holding. That would be a separate asset and subject to a separate fee in your account. So you do have the ability to do it. It's just most clients have just their accounts with us holding the alternative assets. But again, in kind, we can take in kind of other, well, quote unquote, alternative assets like real estate into the account.
And what is the fee structure for just cash transfers before an investment?
Yeah, if it's just a cash, again, initially it's the $50 account opening fee. You move the cash to us. The $95 investment fee, which we kind of went through that case study, that's us doing that paperwork and working with John to get the documents completed. That's the $95 processing fee, and then the annual $295 fee would kick in once the investment is made. So initially, you're just going to have the $50 account opening fee, and you move cash over while you wait for an investment.
For those who are managing, I guess, the cash flows closer to retirement or even thinking about potentially retirement, I understand like it's treated just as any other IRA. So if it's traditional, treated as such. If it's Roth, that's where it gets a little bit more interesting, where you can take the contributions of the Roth out of a Roth and utilize that tax-free. So do you have any thoughts around any of that, like being able to utilize some of the monies before possibly retirement, or even at retirement, you would have minimum distributions as well?
Yeah, I think one thing that gets brought up with what we do and with the alternative assets, definitely, John, as it comes across, is the required distribution. So with any taxable IRA, so any basically not, Roth IRAs are not taxable. Therefore, they're also not subject to required distributions when you hit retirement age. So it's a little bit different. But the traditional IRAs, your old 401ks, you're required to take out a minimum distribution starting at age 73. You have to take some money, your assets out of the account and start to pay taxes on it. So if the IRS really has given you the benefit of all those years of tax deferral, they're saying at 73, you have to start pulling some money out, start paying some taxes on it. So at age 73, it's usually about 3.5 to 4% of your total taxable accounts that you have to distribute. With the investments with us, considering a lot of them are illiquid, it makes sense to make sure, when you're getting close to age 73, make sure you have some cash in IRA somewhere that you'll be able to satisfy that RMD. It makes it far easier to take your RMD of cash than trying to distribute pieces of an asset, of pieces of a piece of real estate or of a fund. So haven't really had clients run into that issue before, because most people, again, have IRAs with multiple custodians, and you can satisfy your RMD from any one or combination of those different accounts. So that's just something to consider when you're looking. If you're about to hit age 73, you would not want to take all of your cash and put it into an illiquid asset. If it's not producing any income, right? So because you're going to have that issue.
Got it.
We
We
are.
have one question. Go ahead.
We're coming up on the top of the hour, and
Yeah.
another meeting after this. I don't know how transferring hosts works or if the recording still stays intact. So we're gonna play it safe. So for now, at least, I think that's gonna be it. Scott, we'll love to have you back on again. Obviously, we've done
Absolutely.
a lot of business together. A lot of my investors have worked with you to come into opportunities, and this has been a wealth of knowledge, even for us, even though we've been working with our investors on self-directed IRAs. What's the best way that folks can get a hold of you, learn more about self-directed IRAs?
Yeah, I mean, our website is advantaira.com. That's a good if you want to just kind of poke around and get some more information. But you reach me directly. My number is it's 800-425-0653. My direct extension is 1123. Or you can reach me at smaurer, SMAURER, at advantaira.com. Just shoot me an email, or obviously reach out to one of you guys and you can hook them up with me as well. But yeah, reach out to me directly. Happy to go over your individual situations.
Okay. Well, thanks for coming in to teach us more about self-directed IRAs and how they work, Scott.
Yeah, great. Keshav, John, it was a pleasure. Appreciate you having me on.
Yeah. So
Thanks, Scott.
We'll include Scott's information in the description for the podcast episode. And for those of you listening at home, wherever you're listening on whatever platform, don't forget to like and subscribe and leave us a review. It really helps us out in getting this education out to more people. So thanks everyone for joining us today, and until next time, keep learning to invest for generational wealth.